Okay, the first rates then on your screens, and a big move actually, nicely above the 18K mark. 18,075 is where we're currently at. A lot tempered for the Nifty Bank. Let's see what Reliance and what ICICI Bank are up to. By the way, it's a better day when it comes to the broader end of the market. I can see the small cap index holding up about almost 0.5%. So in that sense, outperforming what the benchmarks are currently doing. Reliance holds up 0.5% after that 2.25% move that it shut shop with in trade yesterday. ICICI Bank holds up 0.5%, 875 is where the stock is, and Tech M as well see some follow through, holding up almost 1% as we speak right now in trade. Of course, Reliance is going to be in focus. Considering that special additional export duty on diesel has now been cut to about 2 rupees 50 paise from the earlier 750. There's also Dalmia Bharat, wherein the CCI has approved acquisition of target assets from JP Associates. This PI Industries, a big buzzer from yesterday, continues to react smartly to its guidance. FY24 capex has been set at 800 to 850 odd crore rupees, and they're targeting a revenue growth as of 20%, and 23 to 24% is the kind of margin band that they are looking at. There's of course Adani Transmission and Adani Total as well. The weight reduction in MSCI index has now been postponed to the May review, so maybe some relief coming in there. And Interglobe Aviation, I think that block deal has happened. Shobha Gangwal was looking to sell 4% stake. But let me hand it over to Nikunj.
It gives me a great pleasure now to welcome Mr. Ramesh Damani on ET Now. Over the years, I've interacted with him almost 2 decades now. I've learned a lot from Ramesh Damani as an investor, and more importantly, Ramesh Damani as an individual human being. So it's an absolute delight, and I always look forward to interacting with him. Our viewers, rather, more than me, look forward to hearing your views. Mr. Damani, good morning. How have you been? Long time.
Good morning, Nikunj. Thank you so much. Yes, I've been just fine. As you know, I've been my grandfather, so I'm enjoying grandfather road, and plus I've been traveling, so I've been a bit remiss not being able to come as often as you've asked me. But thank you so much for inviting me today.
Mr. Damani, while the consensus call on India has been well received and it is well documented, but last 12-18 months, the markets per se have been difficult to call. Extreme volatility, lot of sectoral churn, and if I take the banking sector aside, the leadership in this market is lacking.
Let me address these points, Nikunj. First of all, let's take the budget. This was the first post-pandemic budget in 3 or 4 years, where the government, had some fiscal leeway and they weren't doing fiscal stimulus out there. And this is the challenge that I feel New Delhi faced, that our great geopolitical rival is China. And India is a much younger country than China. It has, I think, 350 million people below 14 years of age. China has only 250 million people below 14 years of age. But despite that, India's GDP is now only 16% of China's GDP, which was as high as 60% maybe 3-4 decades back. So the central problem that our planners face is how does make India, China competitive with each other? Given the geopolitical situation, the world needs a strong India. So the budget decided, I think correctly, to focus on infrastructure, to focus on capex, and to focus on PLI. Because while India has become a good cyber power, superpower, a lot of good jobs are in technology, if India has to compete with China economically and have the heft in the military clout, it needs a GDP to match China's. And that can only come through manufacturing and manufacturing jobs. So I think by building on infrastructure so ruthlessly, as this government has been doing for the next 5-10 years and the last 5-10 years, I think that will step up the pace of investment in the economy. So while at this time it might seem that we're still sluggish, I think we're laying the groundwork for catching up with China in the next decade or so. And it's imperative that we do that because we have, so many young people coming to the workforce in the next 4 to 5 years.
But Mr. Damani, some would argue that while things are just moving in the right direction for the economy per se, the markets have been stuck in a range. Last 12, 13 months, Nifty has just gone nowhere.
Because I get very weary of people saying that. I mean, the index has doubled in 3 years. And if you expect more than that, I don't think the stock market is the place for you. I think it's done well. You pick stocks bottom up, you've done well. The index itself has doubled. Forget picking the stocks. So markets can go through periods of consolidation. This was a disappointing earnings season, as you said. So that's fine. But I think the point I always make is that the bull market that started when the finance minister announced the long-term rates in income tax for corporate India 25% is still intact. It's still headed higher. And I would wager to you that we're just consolidating before we move up the next leg higher. I get a bit, impatient with people who believe that the index should go up linearly 15-18% a year. Otherwise, things are not good. I just don't think that's true.
A lot of brokerages are making a view that, okay, India is a great story, but it's an expensive market, which is that you are pretty much buying silver at the price of gold.
You can say that about individual stocks. I talked to a fund manager at Fidelity a few days back, and he said, in his opinion, India deserves a higher P than the other emerging markets basket because there's a better respect for capital, the high interest rates out there, and they don't socialize profits as some of the emerging markets are doing. And I think India as an emerging market class will always trade at a slightly higher PE because the amount of high quality, high governance companies is relatively poor and relatively restricted. So the companies that everyone wants to get into, particularly the retail India, they know what the good companies are because they've they have local nuance. Will probably trade at a premium to the rest of the basket in Asia and maybe even America. But I mean, that's historically been true. Now, if you can't stomach some of the high PEs, I still think we look far enough. You get some more attractive stocks at lower PEs. But I think that's parcel of investing in India is finding good businesses with good cash flows and good management and not worrying overly about the price earnings ratio.
I'm going to take a leaf from your earlier answer that the bull market is still alive and kicking. And this is a question which in a sense is for the larger audience and for folks who got SIP and who are now compulsory sticking to that asset allocation. So if the starting point is today, which is 16th of Feb 2023, do you think in next 3 to 4 years it is reasonable to expect that equities will give a double-digit CAGR return?
See, I hope so. I mean, just to answer your question point blank, I hope so, and I believe so, and I'm positioned for it to do that way. But I think you need to understand the intellectual reasons why there's a band of people who seem so bullish in India, and I include myself one of them. Despite all the current imbroglio that's going on with other parts of corporate India or the sluggishness of the economy, the poor earnings season that we went through, every bull market has a reason, Nikunj, as you know. Let's say the 92 bull market, it visualized liberalization was going to take place in India. Say the 2000 bull market, it visualized India was becoming a technology superpower. So what is the intellectual reason why this market has been headed higher? Why has it doubled since the post-COVID lows? I think there are two reasons. One is demographic and one is a geographic position. Let me take both of them and explain to you. Let's see about the demographic reasons India is going up. Over the next 20, 30, 40 years, China is going to lose 250 million of its population, and India is going to add 250 million population. So India's population is still rising while China is declining. Now, what is the forecast for GDP growth? You need population growth, plus you need productivity growth. So India is in a good position to do that, if you will, because you're adding so many people, so many new consumers into the economy. The second reason is the geopolitical importance. I think the world has realized they need a counterbalance to China. And if you look at the Asia Pacific region, there's only one economy that can challenge China's in terms of heft and size, and that is India. So we are at the right place at the right time. And because of the huge push we made in the last 10 years in infrastructure and continue to do that, and the understanding that if India has to catch up with China, we need a manufacturing strategy, we need a service strategy, and we need to provide leadership in the region. I think because of our political stability, because of demographics, because of the geopolitical where India is situated in the world as a counterbalance to China, I think all those are the intellectual reasons I point out that this market will outperform for a long period of time. And the idea that because you don't outperform 1 quarter or 3 quarters or 4 quarters, and people say, oh, it's over, the bull market is over, I think that belies what has happened in the last 40 years in India, where the index has gone, as you are well aware, from under 600 to over 60,000 right now. So I think it doesn't pay to be bearish on India. It pays to be bullish. It pays to be invested. And for whatever it's worth, I think I've heard these naysayers for a number of years, but I would remain invested in high quality businesses.
I'm going to switch sides officially from the bearish side to the bullish side. And let's have the glass half full approach here, Mr. Damani. Whatever could go wrong has gone wrong this year for equities. The Adani Group fiasco, pent-up FI selling, lot of volatility in terms of how the earnings season has been. But Nifty is still holding on. So can I say that somewhere the ability of this market to stand up to the bad news is quite remarkable?
Of course, Nikunj, that is the hallmark of a bull market, that, the market goes down and rallies back. It's sharp, swift, and, very quick. You can be cute and time the market, and maybe you'll get it right a few times. You'll be selling at the top and buying at the bottom. But a long career, you'll miss some of the great opportunities in life. When I came back to India in the late 80s, if you told me that over the next 30 years, India would go through various problems, global financial crisis, Kargil, change of governments, whatever, I would thought maybe India isn't a hot place to invest. But we've been through all of that. We've been through demonetization. We've been through inflationary periods. We've been through election changes. And yet the index is fairly close to its all-time highs, 5% below its all-time highs, perhaps. So I'm not sure what the pessimism is. And what is your alternative? I mean, your alternative is putting in fixed deposits in India, in which you're going to lose money on a real-time basis, because the purchasing power will be eroded by inflation and taxes. So equity is a great place. I think the Indian public has wisened up to this market. Yields are good, returns are good. And if you get a subpar return for 1 or 2 years, that's just part of doing business in equity markets. I mean, I think the biggest myth people have is the equities should give linear returns. They should go up 12, 15% like clockwork every year. Unfortunately, that can and will never happen, because if it happens, the stock market institution will, cease to exist. It always goes between fear and greed. And right now, there's somewhat more pessimism than is warranted by actual reality on the ground.
Adani Group of stocks, Mr. Damani, they have been at the center of the storm. Should one look through it?
I missed the question.
Should one look through what is happening in Adani Group of stocks in terms of the impact it will have on the markets?
I think so. I mean, I don't particularly follow that group because, as you know, Nikunj, I follow the small cap and mid cap space more aggressively. So it's a bit above my pay scale, and we'll see what report SEBI comes up with finally. But to answer your question straight on, yes, we should look through it. I mean, if there's collateral damage, we have to deal with it. But I think my best advice to people, and the way I'm positioning my portfolio, is to remain fully invested in this Indian market. I think it would be a mistake to try and get too cute and get out of this market.
But in terms of real impact, because the Adani Group, in a sense, is a leverage group, and since banks have exposure to them, do you think there could be collateral damage on that account?
Again, Nikunj, I'm not. I don't really know their leverage positions, and I'm not really the right guy to ask these questions. We'll see once the report comes out what the extent of the leverage is, and if there's backed assets or not backed assets. So at this time, the best I can say is that remain invested.
Mr. Damani, you've always said that, look, for an investor, the importance of price is paramount, which is that when you're investing, buy something cheap. And there was a time, I'm just bringing this point for the benefit of our viewers, that you bought into airline stocks when even Warren Buffett was not buying into airline stocks, because you found them cheap and attractive. So in your definition, in this market where things are reasonably priced, what is cheap and attractive?
Well, Nikunj, I'll tell you the two new sectors that we've been trying to bet on. Some you may be familiar with. Data, as everyone keeps telling you, Nikunj, is the new oil. I mean, that's now a well-known fact out there. Now, data has a lot of components. You've got to aggregate it, you've got to analyze it, you've got to put intelligence out of it. Now, if you look at the companies in India that do specialize in data, I think their employee cost as a percentage of revenues is between 60 and 70%, which tells me two things: that this business is coming to India, because if India is paying 70% in salary costs for this business, it's clearly a business that cannot be done in America or London or Germany. It has to move to India. So there are a lot of new companies in there that are using data either to aggregate it in a database or ship it out in intelligent forms. So I think the first sector of new ideas, if you wish, is we're looking at those set of companies. because we believe that the cost basis of that business also almost ensures, given that we have now good telecommunication and cheap property prices, that the business will shift to India. The second business, which you, as you know, I've been bullish on the last few years, is particularly some of the defense and railway PSUs. And given the government's capex push in railways, particularly, I think there's some very cheap stocks. I use that word advisedly, cheap stocks in the railway space. And if you notice the last few days, there's been a lot of noise of India becoming an export powerhouse in the defense sector. Now, if India is going to be an export powerhouse on defense, $5 billion is the number bandied around next year. I think a couple of listed companies which will have to benefit dramatically from that push. So I would say you go for data, and then I would still stick to some of the cheaper defense and rail PSUs, particularly because of the capex and export push that they're experiencing.
But are these businesses, especially the defense stroke railway businesses, are these high quality businesses? Because the top line may be great and the government commitment towards defense and railways is strong, but some would argue back and say that these are not the best of the businesses when it comes to return ratios.
Well, I disagree with that. I mean, I'll give you an example of a company that I still own, and I'm only saying it as an example, not for anyone to buy it or anything like that. So please be very careful. You remember, Nikunj, in the early 2000s, we used to buy a company called Bharat Electronics, which I own today also, but I'm not recommending it. I'm just saying that the stock from those lows, it was a 300 crore market cap, it's now 60,000 crore market cap. So over the years, it's compounded for investors, paid a very rich dividend yield. So I get very a bit upset with people who trash, throw the baby out of the bathwater. It is your job as an analyst to find the good from the bad, the good PSUs from the bad PSUs. Don't necessarily look at the resource-rich PSUs or the telecom PSUs, but others look at, just like you can fail in the public, in the private sector enterprises, so many businesses in private sectors have failed miserably. So in PSU, and the aggregate of taking all the PSUs in one basket and looking at the returns of 10 years is misnomer, because you're comparing apples and oranges. So you look at defense PSU separately, railways PSU separately, commodity PSU separately, and then you'll start making more intelligent decisions. So I completely and totally disagree that the return ratios are bad. In fact, some of these dividend payouts, return on capital, cash flow yields, corporate governance, matches that I have seen in some of the better private sector companies. And at the end of the day, you're making money in them. I mean, that's always the test in the stock market, that are you making sustainable money in them? Because they're paying you dividends and they are, generating cash flow. And I think they are. So, I'm happy, if people are ignoring it, that's okay. It gives me an opportunity to buy these stocks cheaper, which I am. But, we're not necessarily wedded to PSU. We're wedded to good PSUs that are delivering for the shareholders. And we have lots of private sector companies. So if you're not comfortable, all means go ahead with the private sector companies. But if you're an analyst sitting in Bombay and trying to figure out cheapness and value and growth and prospects, I don't see how you can ignore that basket.
Mr. Damani, you've always, in a sense, emphasized the importance of mean reversion and market cyclicality. There are phases in the market where dividend yielding stocks have done well. There are phases in the market where growth stocks have done well. There was a phase in the market where infrastructure and commodity stocks did well. So for next 3 to 5 years, what phase of the market we are in, and what is the template which will work for an investor?
Again, the first template we believe, Nikunj, is that we are still in a bull market. That's very important of how you position yourself. We think the bull market will be driven by demographics and by India's geography. So any companies that can benefit from that, maybe it's inward-facing companies, maybe it's companies catering to population bulge, housing finance, or anything else. And these data companies are, of course, export-facing, but we still think there's a value proposition there. So I think, having gone through the first 2 layers of understanding that we are in a bull market, we believe that Indian equities will do well, not over the next 6 months or 12 months, because there's no idea how they'll do. But over the next 5 to 10 years, I'm fairly confident that they'll give you a good compounded rate of return. I would invest in those businesses that profit from the demographic bulge that you're facing, from the manufacturing impetus that you're facing, from the service sector that we're still very good at. And, the firm belief that if India is to now compete in the world, it needs to match China in terms of economic heft. So once you kind of understand that, I think it's much easier to find stocks that fit those criteria than just being influenced by the price of the market going down for 2 weeks or 3 weeks.
Mr. Damani, when we met last time, we spoke about fintech and consumer tech, and you said that, look, you like the power of some of these businesses because they represent the new way how the demand and the societal needs would change, but you were not very happy with the valuations. Guess what? From euphoria same time last year, couple of months ago, there was fear. Have things normalized for the consumer tech and fintech stocks?
I think they have, Nikunj. I think they have. I mean, if you look at the numbers first, I mean, all the fintechs and the consumer tech companies report a very strong sales growth, but still profit is eluding them. How good is the sales growth? I mean, if you look at the quarterly numbers at least and divided by about, I would say 90%, about 600 million people are their addressable market. The per capita consumption of a food delivery company per quarter or the per capita consumption insurance company is like 10 or 20 rupees per quarter. So it's very, very low. And I think given the fact that India is going to add 250 million people in the next 30 years, 95% of those people will have access to a smartphone and will access to cheap data. And they've been born post-92, so they're post-liberalization children. And they only know the technology and internet. They're not used to long lines, ration queues, and things like that. So they will be eager beavers, in a manner of speaking, to enter into the fintech and consumer tech space, if you will. So once you look for, then the universe narrows. And I think they're ultimately good businesses, whether it's the food delivery business or the insurance business. They're good businesses. They just came at an extremely incoherent valuation. The market has corrected that. I think if you start looking now more sharply, you will find value in the new tech businesses. And again, I would not try and look for a path to profitability next quarter or next 6 months. But as long as the sales growth remains strong and they have enough money to burn to last them till the profit comes, I think they'll be okay. So my advice is that an initial exposure to these new tech companies is probably warranted.
Right. We are looking at a very big change in the macro regime, which is that from an era of low interest rates and low inflation, we are now moving to a normalization of interest rates and high inflation. How will that change the investment template?
Well, that used to be the fear. I think that 40 years we had a bull market based on low interest rate, full employment, globalization, and the parameters of that have changed now. So we're going to have deglobalization, higher interest rates. My feeling is that I'm not convinced that inflation is headed to a higher plateau. Yes, it's been sticky and it's been bad. Let's take it India and the US, or India and the West, if you will, just to understand what happens. India we've dealt with high inflation the last 40 years, and it tends to be sticky from a period of time. But India is primarily building a new economy. And the new economy, doesn't require a lot of the old amounts of capex expenditure or the old type of inflationary expenditure that takes place. Because you need copper, steel, concrete, and a few computers, and off and running for business. So I think we will see inflation from time to time, but it won't be as severe as it was in the 70s or 80s. Now, let's go overseas. If you go and see the new factories that Tesla is building or Amazon is building or any of the great companies in America building, they're being staffed by robots. And robots, Nikunj, as you know, work 24/7. So they're 3 times more productive as a normal human being. In fact, in America, you can't find people for a lot of jobs. So if you find that robots, which are cheaper and more productive than human beings, are replacing the human capital cycle, it points to deflation because you have productivity growth and you have lower employee costs. It doesn't point to inflation. So I think that, we went through a bad phase because we actually pumped up the economy too much in the Western world, and that led to high inflation. But I think beginning next year, inflation will moderate to around 2 to 3% levels. And I think my sense is the fears of high inflation trajectory are probably misplaced.
Mr. Damani, you've always managed to identify things ahead of the curve. And I'm again going to just expand on this question for a young audience who've not tracked your investing career in last 20 years. I've had the pleasure of tracking that, so I'm going to speak out of experience. You identified IT services in 2000. Then you were able to identify some of the consumer stroke financial NBFCs really ahead of the actual explosive growth. So if you have to, let's say, identify the high growth businesses of this decade, the mature businesses of this decade, and the decaying businesses of this decade, how would you club them?
Nikunj, you're putting me on the spot. It's a tall order. What I think will happen is, if you look at, say, new business, I think people that can use data efficiently, whether it's data center storage, whether it is, compiling data together, whether it's building an India stack, or whether it's using data for analysis and knowledge, I think those companies will do well. And as a sub-rider to that, people doing complex KPO operations, not necessarily the simple basic call center BPO operation, but complex KPO operation. I think given the high salary costs in the West and the problem of finding the right people, it just seems almost logical to me that the entire businesses will, move to India. So if you now look, there may be a dozen companies in India that are specializing in data or specializing in complex, KPO type of businesses, not necessarily BPO businesses. So I think that will be at the vanguard of investors' interest for a period of time. In terms of decaying, I mean, a lot of businesses that are not tech enabled or not internet enabled. I'm on a spot. I'm not able to think. I'm sure there are a lot of businesses that will, not be prosperous. I mean, there's a huge churn in even the S&P 500. Every 10 years, a lot of businesses get thrown out, and a lot of new businesses come in. So, that invariably will happen. But, I'm more focused on businesses that will grow and do well, as opposed to businesses that, will decay. So maybe I'll take that question up more seriously on a next interview with you, Nikunj. But broadly, I feel the index, of course, you must remember the index is very wise in that matter. The index committee always throws out the old businesses, put in the new businesses, the ones with more promise, more market cap, whatever. So the market will reflect the reality of a new composition of business. And if you see the index maybe 3 years from now, it should be, in my opinion, higher than what it is now. And they will reflect not the old businesses, which will be out of the indexes, but the new businesses. So that's a good way to keep an idea of what the market is looking at this time.
Has the crypto bubble finally been pricked?
Which bubble?
The crypto bubble.
Oh yeah, absolutely. I mean, I used to for some time drink the Kool-Aid and believe that this was an answer to government's debasing of currency, maybe as a new gold. But I think I've become more cynical of late. I mean, you can't have a store of value that fluctuates by 60% in 3 months. It's just not going to happen. The sovereign governments are not going to allow Bitcoins to take over their lives. In fact, they will outlaw it if they are becoming a part of economic transaction. And I think it was, it reminded me in many ways of, something called the tulip bubble or the South Sea bubble, things that take place when people ascribe value to assets which have no underlying reason, but only because of a speculative fervor. So I think you're right, the bubble has burst.
When we spoke to you last time, we spoke about how you should invest right now so that your children could really benefit. So I'm going to take it slightly forward. If you have to create a nest egg for your grandchildren, 2 of them, 2 lovely grandchildren, how will you invest for them? How will you create that next egg?
Well, I'll tell you the good news, Nikunj, is that I'm actually doing it. I'm doing it as a real life experiment. I said, we can invest small sums of money for the grandchildren on their birthdays, and we just leave it unchanged for the next 10, 20 years, at least till they reach college age. And, they'll have a legacy, if I'm right, that the grandfather did something for them and the grandmother did something for them. So the first point I would like to mention, because this is a great idea, because if you look back at the last 30 years, people who invested very small sums in India, at 1,000 level of the index or 1,500 level of the index, or even at 4,500 of the index, the March 92 when it topped out in the 92 bull run, still have made out like bandits over the years. Some have made 50x, some have made 75x. in the next last 30 years, you could have done any number of things, but you remained invested in equity, you actually became rich. So with the belief that the past is going to be prologue and what happened in the past will continue happening in the future, that the Indian market remains to be excited, I think it's a good idea to, I would strongly think it's a great idea to invest for your grandchildren. Now, what do you invest? I mean, if you're someone who has no time to follow individual stocks, it's very simple. Buy an index tracking fund. When the market corrects, buy a fund that tracks the Sensex and Nifty. Keep it for 30 years. If the Sensex doubled, you double the money. If the Sensex goes up 5x, as it has in the last, say, 10, 15 years, you'll make 5x your money. So it's a great thing to do that. Person like me who's more interested in capital allocation, more interested in finding stocks, we try and find stocks that are gleam in the eyes, small caps that can become mid caps, or perhaps even large caps over the next 10, 20 years or so. Unfortunately, the SEBI regulations. I can't discuss names with you, Nikunj, but I would suffice you to say that I have been doing it, and I'm finding things that I want to hold for 10, 20 years, and hopefully they'll be right, and they will be a mother lode of value for my grandchildren at the end of the rainbow.
But when you're investing for your grandchildren, Mr. Damania, I'm sure you are more than companies, you are betting on themes, because that's what investors can do. You cannot specify 20 years down the line which company will make it big, but you can certainly specify that that area in which you are investing in, that area or that business or that sector could become big. So can you throw more light on that?
Yeah, I mean, we bought, to give you examples, some consumer companies. There are, just without giving names, there are watch companies that are trading at, not the Titans, but the other ones are trading at, fairly, reasonable valuations, which seem prospects look good. There are, fintech companies. Finance is going to be a very important part of everyone's life and continue to be, particularly in the right answer. I don't think Bitcoin is going to take over the rupee at any time in the next 40, 50 years. At least I don't think so. So, some of the leading fintech companies are, good places to park your money. Some of the businesses that I was well known for in the market in the 2000 era, the spirits company. I mean, as the immortal line in Diwars, when Parveen Babi turns to Amitabh Bachchan and says, he's drinking because he's happy, he's drinking because he's sad, he's drinking because he's friends. So these are almost universal businesses. So, a little bit of that in the portfolio. So, there are themes it might not be cyclical businesses because you don't know what the shape will be in 3 years, 6 years, 9 years of these businesses. But there's some business stories that are secular that would, I think, continue to prosper over the next 5, 10 years. Or the market cap is so small that even if it's cyclical, they will still fall from a much higher base each time. So it's a very difficult question to answer without giving you specific examples. Unfortunately, I can't give you specific examples.
2 more last questions, and this is just to inspire a lot of young investors. You've always endorsed the importance of patience and power of compounding. In your investing career, if you could share 2 examples for the viewers and for those who are watching the show online, that how power of compounding has worked for you, some stocks which you held on irrespective of what the macro and what the tone of events has been, and how you are now reaping the benefits of that.
Yeah, Nikunj, great question. I love to talk about this compounding because if you ask me what liberated me in my life and what made me financially free, it was when I understood compounding. Compounding is how your money becomes wealth. And, there used to be an old gentleman in the Dalal Street who, you must remember, I have an MBA. And despite that, I learned the compounding lessons from an old friend of mine called Chandrakant Sampath, who unfortunately passed away a few years back. And he used to sit down and explain to me the power of compounding. And he would say that if you get your money double every 3 years, no matter what amount you start with, at the end of a 30-year period, which is your professional career, you'll have 10 doubles. And at the end of the day, you'll be a very rich man if you do that successfully over a period of 30 years. And you must recall that for a lot of us, between 95 and say 2005, 10, 15 years, the very low capital gains tax in India, very low tax on dividend. So we compound at those rates for long periods of time and add substantially to our wealth. So we were very lucky in terms of that generation. But the point is that you can start with 5 lakhs, 10 lakhs. It doesn't really matter. The important thing is to first invest in appreciating assets and not depreciating assets. Because appreciating assets, you could get wrong. Maybe it won't work, but maybe it'll compound for you. Depreciating assets like buying a very expensive car or taking a very expensive vacation or buying a very expensive clothes, will almost certainly go to zero over the next 3 to 5 years. So the first rule of law is that you buy and invest in appreciating assets. The second rule of law is that you hold it for a long period of time, compounding give you magical returns. For example, as I pointed out to you, if you invested in 1990 when I came to India at 1,000, today you've made almost 60x your money, is surely in terms of the index. Okay, so long term, Indian equities have returned about 15-16% CAGR. Okay, if you add dividends, add another couple of percentage points to dividend. If you can do instead of 70-80%, maybe 21-22%, that means your money is doubling every 3 years. And you can start with almost any amount of money, Nikunj, 5 lakhs, 10 lakhs, doesn't really matter. At the end of the 30-year period, you're going to be fairly rich if you follow the principles correctly of compounding money at 21-22%. And let's say you can't do it 20%. Let's say it's too much. It's too much a burden after taxes, after losses, all the company. Okay, compound at 15-60%, double your money every 4 years, double your money every 5 years. You're still going to be in with a mother load of returns at the end of 30-year period. And that's the way to view the stock market, is that you want to view it over a 30-year period. You want to say that I'm going to do what I want. I'm a hairdresser, I'm a lawyer, I'm a software engineer. I will continue to do what I'm passionate about, build buildings. I don't care what you want to do, build buildings. But if I have money that I save or in excess of my expenses, that you need to invest and grow at that 18-20%, if you will. And if you do that, you're not only going to be successful and happy in your professional career, but you're also going to be financially free. And that's the goal. I mean, when you're 60 years old, you want to be able to take care of your children's education, your parents' health, your housing needs, whatever. And that's the reason you're building up. And India is giving you that great, stable tax rates, great universe of companies, and a great opportunity that over the next 20, 30 years, the index will be substantially higher than it's today. So there's a lot of feeling, Nikunj, that, oh, you're lucky, that's why you're saying that, because you came, the index was 1,000 and it's now 60,000. So you guys in your generation were the lucky one, you benefit from all that growth. But I will say with deep respect that I believe the next 10, 20 years will be as exciting as the last 20 years, at least in terms of stock market returns. So if you don't have a demat account or you don't have exposure to stock, I would think that it's a good time to, take care of those two and think of yourself for the next 10, 20 years rather than the next 2-3 quarters.
I would request everybody to watch and revisit and rewind and watch Mr. Damani's answer again on the power of compounding and how all of us should really apply that not only in our investing life but also in our daily life. My final question, sir. It's been 9 months, sad, true, disheartening. India has lost one of its most famous investors, Rakesh Jhunjhunwala, a common friend and a very dear friend of yours. What do you miss about him?
First of all, on budget day, it was very hard for all of us. I know a lot of people in his office. We all as friends get together for a post-budget party. And the most sought after opinion on budget day was always his. And, Nikunj, it's actually astonishing how many budgets he got right, starting with Madhu Danwade's budget to the last Sitaraman's budget where he said the bull market's continuing. I don't care what anyone says. He always seemed to be on the right side of the budgetary moves. He was always bullish on India. I think some of the lessons we learned from him still resonate very deeply within me. I miss him in so many aspects. I miss him as a friend because we were socialized together. I miss him as an investment guru who taught us how to think, taught us how to look at Indian markets. And I miss him as a strategist, someone who actually put into my head that be bullish in India. You need to understand what's going on. It's very easy to be cynical. So there are many, many facets of Rakesh I missed. And I think just to add to the last question that you did, I actually did his compounding returns in his career. I think there is nobody in the history of the stock market or the history that has compounded wealth at a bigger rate than he has in the world. I'm saying that. He started with 5,000 rupees, Nikunj, as you know, and he ended up with $5 billion plus, and I'm being charitable, it's probably more than that. That gives you a dollar compound rate of about 45-50%. A dollar compounded rate. Warren Buffett compounds at 20 to 23%, and he's on every magazine cover in the world in dollar terms. And here's a guy who for 30 years did it at about 40-50%. So he's truly iconic, truly one of a kind. And I'm very grateful to the government of India to honor him with the Padma Shri as they did recently. And, he will always be missed, but his learnings in terms of, how to approach the market, how to think about businesses will always stay with us. And as they say, a teacher affects eternity because his legacy never stops, and neither will his.
And what an extraordinary human being who's really inspired generations of Indians that why to believe in India, why to bet on India, and more importantly, how to do it in efficient and a very fair manner. So Damani, really appreciate your time. I'm so glad you found time to join us. And here's a sincere request from everybody who's watching the show that please find time to join us more often on ET Now.
We'll do that, Nikunj. Thank you so much for having me today.
All right, those were some pearls of wisdom coming in from Ramesh Damani, but let's put the spotlight then on Spandana Spurthy and Shalabh Saxena as the MD and CEO now joining in on the show. Thank you so much for taking time out and appreciate your patience. To begin with, I'm just looking at your numbers and basis what you've delivered. It's visible that you're managing to grow customers very aggressively, 77% on a sequential basis. What exactly is driving this growth? What's changed over the last couple of quarters?
So good morning to all your viewers. Thank you for inviting me. To answer your question, there are two things. The first is there's a base effect. So that has to be looked at in context. Number one. Number two, as a strategy, when we came up with our Vision 2025 document, where we said this is where we want to take the company to at a 18,000 crore level from the current 7,000 crore. We had articulated a higher customer acquisition in the overall scheme of things. For two reasons. One is these are customers who have crossed through relatively nicely in the COVID period. That's number one. Number two is they go through the entire CV checks, etc. So our customer portfolio needed some bit of a churn. So that's the reason why we've kind of very clearly said that directionally we will acquire more customers, and that's the reason about 46% of the loans over the past 2 quarters have been going to the new customers. So it's a part of our strategy, and it is playing out the way we had envisioned.
So do you think that this momentum can continue going forward? Do you have any targets when it comes to your member additions?
Yes, so it will taper off for sure, but it wouldn't still be at a number anywhere between 35 to 40% will still continue for the next 3 to 4 quarters. Number one. Number two is our target is very clear. By end of FY25, we will have about 4 million customers. We are at 2.3 million at this point in time. We are on track, and I think we should be able to deliver.
Your disbursement guidance for fourth quarter stands at 3,500 crore rupees. Is there a target that you have for the full year as well as FY25 too?
No, so this year when we end the year, we for a disbursement of anywhere between 3,000 to 3,500, we should end at a portfolio of upwards of 8,000 crores. So we have once again going back to the strategy that we had carved out. We should end this year roughly at the number that I said. Next year will be around 11,000 plus, and then 15,000 on the microfinance book end of FY25. So we have about 8.5 quarters to deliver a 15,000 crore microfinance book. And there are two new businesses that we've articulated, which is the nano MSME and the affordable housing. That is another 3,000 crores on top of 15,000 crores. So that's the articulation, and I think we are taking all the steps to ensure that we walk that path and deliver.
Sure. So, but along with that, can one assume that you're also comfortable with the risk that you're taking? I mean, wanted to understand what your guidance or target is with regard to credit costs, for instance.
Yeah, so that's a very, very important question. Any growth minus risk or minus quality, it does not mean anything. And as a management team over the past 3 quarters, that's what we've been focusing on. Our numbers are there. We are in control of the portfolio, and I think it will further improve over the next 2 to 3 quarters. That's number one. Number two, any microfinance company, if it is able to, it should deliver a 1.2% loss rates. That's the current trend. And if it delivers that, then I think, it should be good. as far as our P&L, etc. is concerned, we budgeted higher. We budgeted a 2% for all the financials that we've given. So, we're just cushioning it, but I think we should be around that number that I said.
Okay, and your net interest margins as well have risen to nearly 14%. What's the outlook and what will be your levers for expanding your net interest margins?
So we are at about 13 and a half. So any number around 13 and a half, 13.7 is a good number on a sustainable basis. So, so I think we will hold on to it. The yields are at about 21% at this point in time. But over the past 2-3 quarters, we've been as a company at about 25% because of the rising interest rate scenario. So the portfolio yield over the next 2-3 quarters should inch up to anywhere between 23 to 23.5%. On the quality of portfolio perspective, we will have a lot of because the new book that is being sourced is fairly, fairly pure. So from that point of view, that will further add to the delta of the profitability. So on the NIMs and yields, I think, a 13 and a half, 13.75 should be good enough on a sustainable basis. Yields would probably go up by maybe about 2% from the current levels because of the shift in portfolio.
Okay. You're also planning advanced branch opening as well. So costs will remain elevated, I'm guessing, in the near term, wouldn't they? And if you could give us a guidance on how should one look at the ROAs then in the near term?
Yeah, so it's a fair point. This is all growth investment which is coming in. In fact, we were reasonably happy with the progress that we were making in spite of a very clearly articulated strategy for the next 3 years. So looking at the movement and the positive movement, if I may say, what we've done is we've preponed opening about 200 branches, which we were otherwise planning in Q1 of next year. We kind of were getting almost about 100 branches this quarter, and then we'll have the balance in the beginning of the Q1. So that's just an indication because microfinance and even large distributions, we have about 1,200 branches. We are targeting 1,500 branches by end of FY25. But in all likelihood, we'll open all the balance 400, 500 odd branches in the next 3 quarters of so that we have a clear runway. All the 1,500 branches have a clear runway in the FY25 of all 12 months. So that's the clear that's a clear indication of the reasonable progress that we are making as a company. So to that extent, we have also articulated that there are 7 states where we are going to increase our presence because right now we have a marginal market share there. So those states are the states where we are kind of adding all the new branches.
So do you see a substantial change in your loan book as the current growth guidance starts to kick in?
Yes. So one of the fundamentals of a microfinance is how well you manage risk. And a very key element of risk is concentration risk. So this is a step in that direction. Once we spread out our distribution across all the 21 states, we are currently present in 18 states, but the 7 states we have a marginal presence. So once we do that, we'll be able to balance our portfolio geographically across the country. And that kind of will ensure that, we are fairly well balanced across the country. Incident here and there in a particular state should not really upset the portfolio of the company, and that's our motive.
Appreciate your time. Thank you so much for joining in and giving us a view on your growth outlook. So acknowledging that, yes, as of now, there could be a mild blip, but the company is definitely working towards improving their overall operational metrics. Just a quick check-in on the markets and where we stand at the current juncture. Well, yes, 18,100 on the screen. The broader markets as well looking pretty rosy. And you've got names like Tech Mahindra, ONGC, Adani Enterprises from the frontliners, along with Reliance Industries, of course, leading the way. And within the broader universe as well, given that there's fervor all around, there are names like Tanla Solutions, PI Industries continues its up move. There's Bharat Dynamics as well as Solar Industries, which is up about 5%. Take a look at Tech Mahindra. Continues that 5% up move with another 3% plus, and ONGC recovers along with Adani Enterprises. But let's put the spotlight then on luxury car sales. They've been on a roll, especially post-COVID, with all that pent-up demand and revenge travel trends. So will these trends sustain? And what's next when it comes to luxury cars in the country? In the latest edition of Mega MNCs in India, my colleague Anisha Jain caught up with Mercedes-Benz India MD and CDO, that is Santosh Iyer. Let's hear out an excerpt of that conversation.
I think post-COVID, we definitely saw a bit of, we call it revenge buying kind of a phenomena. A lot of pent-up demand was also there because for the last 2 years, the overall market was down. And to add to it, we also launched a couple of new products. So we definitely have seen a very big surge in 22. 23, when I look at January, the order intake has been good. So I think the demand momentum still continues. What we have been trying to do is to increase production because, in post-COVID, consumers were ready to wait for 12 months, 18 months for their car. But now in this new world, they want cars at least in 3 to 6 months' time, and that's something quite critical. So our entire focus is how do we increase production, how do we now reduce this waiting period. And a higher waiting period also means lower order intake because, as I said, they need cars for some wedding in the family or some birthdays. And if you are unable to provide, then they start feeling, looking out for options, or they postpone their purchases. So the entire game for us is now how do we ramp up our production or increase availability and continue to have a good order bank. Coming to savings, I think these are cultural topics. They won't change COVID, post-COVID as fast as what we would wish to. Frankly, I was referring to the top, interesting statistics. Only 4% of US $1 million households own a luxury car in India.
Oh.
This is 60% in Europe or in China, for example. So my reference point was to the $1 million households who still don't invest on a luxury car, but they would like to invest in stock market, nothing wrong. But at some point, you reward yourself, you consume for yourself, and that was the point which, of course, got out of proportion, but yeah.
So since you're so confident about demand, and there might be situations and, issues with respect to supply chain, but since you're so confident about demand, and you did what, just around 16,000 units in 2022?
Yes.
Should we expect what, 18 to 20,000 in 2023?
I think there are, one is of course, demand side we still don't see a headwind, but on the supply chain side still things have not fully sorted out. So we are still not able to put a number, can we produce these cars and also sell them. But on the other side, certain other parameters are now emerging. For example, the exchange rate, the euro, if you've seen the last 8 weeks, euro used to be at 82, now it's at 86. This puts more pressure on pricing. Interest rates going up by another 0.5 to 0.7 percentage points. So, of course, with this also increases the monthly outflow, etc. For even many, 80% of luxury cars are still bought on finance.
Yeah,
it's not cash.
right.
So, and those guys definitely there would be some amount of sensitivity. So, these two factors have a tendency, price increase followed by high cost. Can have a tendency to again slow down demand. So we need to really wait for the year. But our outlook is still double-digit growth. We still want to continue on this growth journey. We have been here for many years now. And as I said, the initial signs in January looks promising.
Which segment do you see the maximum traction is? Is it like the entry-level cars, or is it the high-end S-Class and Maybach, etc., which are seeing the maximum amount of traction?
No, that's quite interesting. Pre-COVID, our entry-level cars used to be around, say, 30-odd%, and then the top-end segment used to be around 12%. Exactly post-COVID, if you see last year data, 22% are coming from the top end. And when I say top-end vehicles, these are cars more than ₹1 crore. The S-Class, the GLS, the Maybachs, AMGs. And these cars today, and that's substantial, 22% coming from plus +1 crore out of a volume of 16,000 cars that we are selling. Also the growth, that segment has grown by 69%. And that also shows a lot of affinity. So the good part is Indians are not buying cheap luxury cars. They are buying good cars, well equipped, well specced at the top end. What we have also done consciously is in the so-called entry luxury, which is in the region of 50 lakhs, because even an A-Class today costs close to 50 lakhs and a GLA around 55. I am saying the on-road prices. These cars also we have specced up. So we have not gone with a strategy where we come up with entry-level versions where it doesn't have basic features and you reduce the price. We said that if a consumer is upgrading to luxury, he should get all the basic features, not basic but also all the equipment that's coming in the car, and that should help us. So our strategy is different. No, I would say a price-led strategy. It's more equipment, brand, and of course a good product at the right price points.
Trend that is there at the moment is clearly SUVs, right? A large part of the sales in the last year actually came in from the SUV segment. What are the new product launches that Mercedes has in that category, and what's your own expectation of how that particular product is likely to pan out?
See, for us, the product portfolio, we are quite healthy. We have around sedans and SUV, we used to have a share of 50-50. But last year, our SUV share went up to 53%. Two reasons. One, of course, consumer preferences are changing. They want a better body style and a bigger body shape as such. On the other side, our C-Class, which was one of the largest selling sedans we have apart from the E-Class, that was introduced only in May of last year. So for the first 4 months, we didn't have a sedan. So therefore, the percentiles may be misleading. Coming to SUVs, we have the largest portfolio in the segment. From the GLA to the G-Wagon as such, we continue to bet on that. In fact, the 7-seater also we launched was on a classic SUV design. And we will. The good part is you have a portfolio. Even in the sedans, we have a long wheelbase E-Class. So and a customer has a choice to make. But as I said, when I look at a GLA, 25% of female buyers prefer an SUV, prefer a car in that body shape. So this is again differs from region to region. We have more sedans in Bombay, for example, compared to Delhi, where you have more SUV affinity.
Santosh Iyer of Mercedes-Benz. Santosh, now we are in the Chakan facility, the state-of-the-art facility over 100 acres. And the one thing that you were pointing out was that you're looking at ramping up production. Is it fair to say that the entire semiconductor issue is behind us now?
I would say semiconductor to a large extent is behind us, but still the component level supply chain is still a big issue because we have this crisis in Europe. Many of our tier 2, tier 3 suppliers, they are still struggling to get components. There is energy crisis there, and therefore there are delays for parts. Once we even source the part, there are delays in shipments, and there is a huge logistic issue because ships are not available, containers are delayed, prices have gone up also in the freight industry. So we are still grappling. It's much better than last year, but still a long way to go. So till end of this year, we still feel these issues will continue.
So what's the waiting period right now? What do you plan to bring it down to, and what's the order bank looking like?
See, the order bank is still upwards of 5,000 cars we have right now, and we are still ramping up production. So if I look at a GLA, the waiting period is 3 to 4 months. An S-Class Maybach is 7 to 8 months time. And then we have those top-end vehicles. The G-Wagon used to be a waiting period of 18 to 24 months. And a GLS Maybach again 12 to 18 months. What we have done is, we have discussed with headquarters, we have tried to get additional cars for India, and with this the G-Wagon waiting time will be 9 to 10 months odd. Coming to cars produced in India, the C-Class which should be available now in 2 months and the E-Class in 2 to 3 months. So we have really tried to cut down on waiting period and trying to push production as much as possible.
Almost 30 years for Mercedes-Benz in India since 1994, and it's been a great journey so far with respect to the ramp-ups that we have seen. How do you see the next 10 years panning out, and especially in wake of what your global CEO said, that India is not only the fastest growing market, but is also an important part of the supply chain?
See, I keep telling my team that the next 10 years will be much more exciting than what the 30 years happened for a couple of reasons. One, the industry is going through transformation. We are electrifying the portfolio. 25% of our sales we see in the next 4 to 5 years have to be electric. This won't come by default. We have to set up charging infrastructure, we have to educate the customers, we have to ensure we are able to produce these cars in India. So there is a lot of work to be done. On the other side, India has a role to play in the global scheme of things. As I said, in Bangalore, we have our own sister company, which is called MBRDI, wherein we have 6,000 people working on the future technologies, new operating systems for cars, a lot of digitalization happening there. So when you combine the global contribution from Bangalore, what we do for the Indian market in Pune, I think Mercedes-Benz definitely is poised for the next 10 years, set up very differently for the next 10 years for a, I would say for a very aggressive growth strategy, but it is just not limited to number of cars. It's more limited to what can we contribute by sourcing components from India for the
Right.
world also.
Which is your favorite car? Mercedes, non-Mercedes?
Well, with Mercedes-Benz, S-Class still remains the top-notch car, and therefore when I got into the new job, I was in two minds. But the next one is the EQS because I want to get into the electric myself to drive personally. I drove it for around a couple of weekends. I loved it. But you know, there was this entire thing in life that yes, at some point I will drive an S-Class. So I had to fulfill that, which I took that as my company car. But now the next one is the EQS for me.